Good morning, ladies and gentlemen. Welcome to today's lesson where we will be working through a statement of cash flows question. We are busy with the September-November 2021 examination paper. In yesterday's session, I have worked through question 2, which addressed the group financial statements. That question has been covered comprehensively. So in today's lesson, we will work through question 3, counting a total of 23 marks, and for which we are allocated a time limit of 28 minutes. Now, according to the required section of this question, we need to apply the direct method to the operating activity section. However, I have decided that we would rather want to use the indirect method, because a lot of you seem to be uncomfortable with that method. So we will change the required section a bit, where we instead are going to use the indirect method to calculate the cash generated from operations amount. All right, so please keep that in mind. However, in the suggested solutions, I have used the direct method. But regardless of what method you use, you should arrive at the same amount for cash generated from operations. So please make sure that you are able to apply both methods. It is difficult to say what method is going to be asked in the examination on the 23rd of January. So my advice to you is practice using both methods. And as you should have already noticed, the method that is used only affects the calculation of this amount. All right. So if they ask you in examination to draft the investing activities and financing activities sections, all right, it doesn't matter what method was originally applied. And you will find such a question, I think it was in the October 2020 examination paper, where they didn't state in the required section what method you should use. And the reason why they have not stated it is because you were not required to draft the operating activities section. The amount from operating activities was already provided under additional information. So please go have a look at that examination paper, specifically question 3. You will notice that they haven't stated in the required section what method must be used. It is because you were not required to draft the operating activities section. So the method that was used is irrelevant. The investing and financing activities sections will be the same for both methods. So please take note of that before you start with this question. All right, we are dealing with Ivan Limited, and we are drafting the statement of cash flows for the year ended 31 December 2019. So our year has started on the 1st of January 2019. So before we go to additional information, let us draft the bottom section of the statement of cash flows, so that we know the amount that we have to arrive at once we have done drafting all the sections of the statement of cash flows. Okay, so the cash and cash equivalents at year end has been provided under current assets as 700,000. There is no bank overdraft balance that we need to take into account. So this will be cash and cash equivalents at year end, 700,000. So we will enter that amount right here. And then the cash and cash equivalents balance at the beginning of the year was 300,000. So there was clearly a net increase in cash and cash equivalents amounting to 400,000. So once you have drafted every section in the statement of cash flows, you should arrive at an answer of 400,000 as the net increase in cash and cash equivalents. All right. Once again, in terms of the opening balance, there is no bank overdraft balance that we needed to consider, because if there was a bank overdraft balance, you would need to subtract it from the 300,000. That is the favorable balance of cash and cash equivalents. Okay, so we are done with cash and cash equivalents. Remember, we are using the indirect method. So with this method, In order to calculate the cash generated from operations amount, we first need to make certain adjustments to the profit before tax. The first group of adjustments will be that we need to remove non-cash income and expense items that are included in the profit before tax. So those amounts will be shown in the statement of profit or loss and other comprehensive income. And the second group of adjustments that we need to make to the profit before tax will be that we need to remove income and expense items that have been shown separately in the operating activity section. For example, interest expense must be removed from the profit before tax because we show the amount of interest paid separately in the operating activity section. And when removing that specified amount, we take the amount that is shown in the statement of profit or loss and other comprehensive income, because the actual cash flow is calculated right here. So please take note of that. And once we have made the necessary adjustments to the profit before tax, we can proceed to calculate the changes in working capital. So that being the changes in inventory, trade and other receivables, as well as trade and other payables. And when calculating the changes in these items, we need to consider non-cash items that affect those accounts, as well as other accounts that are included in, for example, trade and other payables. So let's say it includes tax payable as well as dividends payable. Those balances need to be removed in order for us to calculate the change in trade and other payables correctly, because tax payable and dividends payable have been shown separately in the operating activity section. Okay, we calculate the cash paid for dividends or in respect of dividends as well as tax separately in this section. So therefore we have to remove it from trade and other payables when calculating the change in that item. That is with the indirect method. Okay, so let us proceed to additional information. Point 1 says the following. So property, plant and equipment, which is shown under non-current assets in the statement of financial position. So these two balances, so that being the opening and closing balance of property, plant and equipment, comprises or consists of the following. So it includes land and buildings as well as equipment and machinery. So these are the only items that are included in property, plant and equipment. Please keep in mind that property, plant and equipment is shown at carrying value in the statement of financial position. So these amounts will also be shown at fair value or carrying value. So let us draw up a separate general ledger account for land and buildings and another one for equipment and machinery. All right, so in terms of land and buildings, which is measured in accordance with the revaluation model, or disclosed according to the revaluation model. So these are at fair value. So the opening balance for land and buildings, so the balance on the 1st of January 2019 or at the 31st of December 2018, the end of the previous year, the balance for land and buildings was 2 million rand. So the opening balance is 2 million. And then the closing balance for land and buildings at fair value is 5,050,000. Right? We should know by now that an asset will have a debit balance, and keep in mind that the closing balance of 5,050,000 was carried over from the credit side when the general ledger account was drafted. So this was carried over to the debit side in order to be reflected as a debit balance. Okay, keep in mind that it was carried down from the credit side. Okay, now in terms of land and buildings, it is the policy of the company to revalue land every 2 years, and at the end of the current financial year, the land was revalued. So we know that revaluation surplus is applicable, and the revaluation surplus for the current year caused an increase in the fair value of land and buildings. So the first place that we search for the revaluation surplus for the current financial year will be in the statement of profit or loss and other comprehensive income. And in this extract, they have provided the revaluation of property amount for the current financial year, amounting to 160,000. So we know that the journal entry in terms of this adjustment was that land and buildings was debited by 160,000 and revaluation surplus, which forms part of equity, all right, was credited by the same amount. So on the debit side in the pardon me, let me just rephrase that. So on the debit side of the land and buildings general ledger account, you will indicate the value of the current year's revaluation surplus, which caused an increase in the value of land and buildings, and you will disclose the amount as 160,000. That has been provided in the extract of the statement of profit or loss and other comprehensive income. But let's say this amount was not provided as part of the extract. Then we would search for the other components of equity line item in the statement of financial position. So if we look at our equity and liabilities section, in terms of other components of equity, there was a change in the balance of that item. The opening balance was 100,000 and the closing balance is 260,000. So there was clearly a change of 160,000, more specifically an increase of 160,000. And in the absence of any further information, we will assume that other components of equity only consists of revaluation surplus. So the change in other components of equity, which is due to a revaluation conducted in the current financial year, amounted to 160,000. So that is another way in which you can determine the value of the current year's revaluation surplus, which caused an increase in the fair value of land and buildings. All right, so that is in respect of revaluation, and any other movement in land and buildings during the year was to expand the company's operations. So the balancing figure in this general ledger account will be the expansion of land and buildings. So additional land and buildings that were acquired during the financial year. And this would be shown on the debit side because the debit side reflects an increase in the value of land and buildings. So therefore, the balancing figure will be shown on this side. So that amount will be calculated by taking the closing balance that was carried over from the credit side, which is 5,050,000. And then we will subtract the revaluation surplus of 160,000 as well as the opening balance of 2 million rand. This should give you the value of the additional land and buildings that were acquired during the year. And we know that these were acquired for expansion purposes. So in our investing activities section, we need to show the investment to expand production capacity, additions to land and buildings, and we need to show it at the amount of 2.89 million rand that we have calculated in this general ledger account. So investing activities, investment to expand production capacity, additions to land and buildings. Just correct that. So additions to land and buildings that we have calculated in a general ledger account. And because these have been acquired during the year, we know that there was a cash outflow. So this must be shown as a negative amount in your statement of cash flows in the investing activities section because a cash outflow has occurred when the additional land and buildings were acquired. Okay, 2.89 million rand was spent on acquiring land and buildings, okay, for the purpose of expanding the company's operations. All right, so we are done with land and buildings. We can now move to equipment and machinery, for which we will draw up a separate general ledger account. And once again, keep in mind that these amounts are disclosed at carrying value, or these are the carrying amounts of equipment and machinery as at the beginning and end of the current financial year. Right, because property, plant and equipment is disclosed at carrying amount in the statement of financial position. So the opening balance for equipment and machinery was 1.55 million rand on the debit side because we are dealing with an asset once again. And then the closing balance has been provided as 3 million rand, which was once again carried over from the credit side in order to be reflected as a debit balance. Right, carried down to the debit side. All right. Now, in respect of equipment and machinery, in the previous financial year, so in the 2018 financial year, management erroneously purchased a machine that did not meet the requirements to manufacture the specialized products of Ivan Limited. For this reason, the machine was sold in the current financial year, and the profit on sale is included in other income. Now, if we go to additional information point 3, we will see that there is a profit on sale of asset, which just confirms equipment and machinery that was sold. All right. So profit on sale of machinery amounted to 99,000 for the current financial year. Okay, we ignore the figure for the previous year. So we will need to take the profit into account when calculating the proceeds on the sale of the machinery. So in other words, when we calculate the amount that the company has received for selling that machine, we need to take the profit into account. But before we can do that, we need to calculate the disposal at carrying value. Okay, because remember that this general ledger account is concerned with carrying values. So, and the disposal at carrying value will be the balancing figure in this general ledger account. All right, just keep in mind that we need to take the profit into account. All right, the only adjustment that we can make at this stage is we know that the profit itself is a non-cash item, or more specifically, it is a non-cash income item. And because we are using the indirect method, we need to adjust that amount against the profit before tax. So in the cash flows from operating activities section, we need to start with the profit before tax as given in the statement of profit or loss and other comprehensive income. It is very important that you start with the profit before tax, not the profit for the year, because otherwise you will need to add back the income tax expense. So we will start with the profit before tax amount, which is 3,178,000, and then we need to adjust the profit on sale of machinery against the profit before tax. Why do we make this adjustment? Because profit itself is a non-cash income item. Now, since we are removing the profit, which is an income item, we are decreasing the profit after tax. So therefore, this will be shown as a negative adjustment because we are removing an income item from the profit before tax, which means that we decrease the profit before tax. All right. And we need to do this because we are using the indirect method. All right. Back to our equipment and machinery carrying value GL account. Now, management replaced the machine that was sold with a new machine that is more suitable for production at a cost of 2.3 million rand. So the new machine was acquired at a cost of 2.3 million rand. So we will show this on the debit side of this general ledger account because this has increased the carrying value of property, plant, of equipment and machinery, not property, plant and equipment. So therefore, it must be shown on the debit side of this GL account. All right. Secondly, we also need to show this as an outflow in the investing activity section because money was spent on the acquisition of the additional machine and it was acquired to maintain production capacity. Replacement of equipment and machinery. No calculation is necessary because this amount has been provided as 2.3 million rand. Please show this as an outflow because funds flowed from the organization or from the company to the external third party in order to acquire the additional machine for maintaining production capacity. 2.3 million rand. And then the other item that we need to consider in the equipment and machinery general ledger account is depreciation, because depreciation would have been written off during the year on equipment and machinery that caused a decrease in the carrying amount of equipment and machinery. So the depreciation expense for the current year has been included in other expenses as 245,000 rand. So we need to show this on the credit side of this general ledger account. And once again, it is a non-cash expense item. So therefore, we also have to adjust this against the profit before tax in this section right here. Adjusting depreciation, we are removing an expense item. So therefore, it will be it will result in an increase in the profit before tax amount. All right, this is a non-cash expense item, so therefore we have to adjust it against the profit before tax because we are using the indirect method. And furthermore, we showed it on the credit side of the equipment and machinery carrying amount general ledger account because it caused a decrease in the carrying amount of equipment and machinery during the year. So the balancing figure in this general ledger account, which will be on the credit side, will be the disposal at carrying value, okay, in respect of the machinery that was sold. All right, so that amount will be calculated by taking the opening balance of 1.55 million rand, adding the replacement value of 2.3 million rand, and then we will subtract depreciation of 245, and finally the closing balance that was carried over of 3 million rand. You should arrive at an amount of 605,000. So this was the carrying value of the machine that was sold during the year on the date of sale. So in order for us to calculate the proceeds on the date of sale in the investing activity section, because it was an actual cash flow that occurred during the year, we will need, let me just correct this, proceeds from the sale of equipment and machinery. We will need to take the carrying value of 605,000, which we have calculated as the balancing figure in the equipment and machinery general ledger account, and we need to add back the profit that was made of 99,000. If a loss was made, you would need to subtract the loss from the carrying amount in order to calculate the proceeds from the sale of equipment and machinery. However, in this case, a profit was made, so therefore it is added to the carrying amount in order to calculate the proceeds on the date of sale. You should arrive at an amount of 704,000, which must be shown as an inflow because we received that amount for the year or during the year for selling that machinery. All right, wonderful. All right, these are the only transactions that affected property, plant, and equipment. And then the other item that is included in other expenses is impairment of financial assets. Now we will use this amount as part of the calculation in additional information point 5. Right? However, we know, or we should know by now, that impairment of financial assets is a non-cash expense item. All right? Because it does not represent an actual cash flow. So therefore, it must also be adjusted against the profit before tax. So impairment of financial assets amounting to 20,000 for the year. We are removing an expense item, which means that we are increasing the profit before tax amount. Okay, so keep this one in mind in additional information point 5. All right, let us move on to additional information point 2, which states that the following items are included in trade and other payables. So we have dividends payable as well as tax payable. All right. So let us calculate the dividends paid for the current financial year. So when calculating this amount, we will start with the opening balance of dividends payable, which is 45,000. Then we need to determine the total dividends declared during the current financial year. Now, there is not enough information under additional information for us to calculate the dividends declared amount. All right, they didn't state the ordinary dividend that was declared on the ordinary shares of the company. However, we can calculate the dividends declared as the balancing figure in the retained earnings account. Okay, let me show you how we will do that. So, in order to calculate the dividends declared, we first need to draw up or draft the retained earnings general ledger account. According to our trial balance, retained earnings had an opening balance of 5,256,000 Rand. So 5,256,000 was the opening balance. Keep in mind that retained earnings has a credit balance, so you need to show this on the credit side. And the closing balance for retained earnings was 7,329,160 Rand. So 7,329,160 was the closing balance, which was carried over from the debit side in order to be reflected as a credit balance. Okay. Then we need to take into account the profit after tax, which would have been credited to the retained earnings account. And according to our statement of profit or loss and other comprehensive income for the 2019 financial year, our profit after tax, which is the same as the profit for the year, amounted to 2,288,160. So 2,288,160. Right, was the profit after tax, which was credited to the retained earnings account. So the balancing figure, again, will be the dividends declared, and that balancing figure will be on the debit side. So the dividends declared amounted to 215,000 Rand. Okay, I have also shown this general ledger account in the suggested solutions to this question. So this will be the total dividends declared. All right. So that amount will be added to the opening balance of the dividends payable, which is 45,000. And then we need to subtract the closing balance of dividends payable, because that represents the amount that is part of dividends declared, but that amount has not been paid during the year, which is 30,000. All right. And this will give you a total of 230,000, which is shown as an outflow. So in respect of dividends, a total amount of 230,000 Rand has been paid in the current financial year. Right. So we are done with dividends payable. And then we need to calculate the tax paid. So we start with the opening balance of tax payable, which is 80,000. Then we add the income tax expense as disclosed in the statement of profit or loss and other comprehensive income, which is 889,840. And then we need to subtract the closing balance of 30,000. Right? So the total tax paid during the current financial year amounted to 939,840. Okay, 939,840 is the total amount that was paid in respect of income tax. Okay, 939,840. Okay, so we are done with additional information point 2. Keep in mind that when we are going to calculate the change in trade and other payables, we need to consider the balances that have been calculated separately or have been shown separately on the statement of cash flows. We'll do that at the end. Okay, then other income of 300,000, all right, for the current year, consists of the following items. So we have interest income of 121,000. Okay, once again, remember our second group of adjustments that we need to make against the profit before tax is that we need to remove income items that have been shown separately or in respect of which the cash flow has been calculated separately. So interest income amounted to 121,000 Rand, and there is not enough information to suggest that income was receivable or interest income was receivable at the beginning or the end of the current financial year. So Because of this, we will take the 121,000 as having been the amount that was received during the year. But we first need to remove it from the profit before tax as part of investment income, which is just a combination of interest and dividend income. The reason why we remove this is because the cash flow in respect of interest income is shown separately in the operating activity section, and there is no interest receivable at the end or the beginning of the current financial year. So the amount that was received is indeed 121,000, which we show as an inflow. Okay, after we have removed it from the profit before tax. Okay, the previous year's figure is irrelevant. All right. And then the dividend income for this year amounted to 80,000. Once again, there is no information that indicates that dividends were receivable at the beginning or the end of the current financial year. All right, so we take the amount disclosed as part of other income, which is 80,000, as the amount that was received during the year. But we first need to remove it from the profit before tax because it is an income item in respect of which the cash flow is shown separately on the statement of cash flows. So total investment income that we have adjusted against the profit before tax amounts to 201,000 Rand. Because we are removing an income item, that will be a negative adjustment against the profit before tax. Okay. We are done with additional information point 3. We have already adjusted the profit on sale of the machinery against the profit before tax. Then additional information point 4 just confirms the cash flows in respect of dividends paid as well as tax paid. The dividend paid for the current year or the current financial year amounts to 230,000, which we have correctly calculated, or that we have calculated correctly. All right, 230,000, and taxation paid amounts to 939,840, which we also have calculated previously. 939,840. So additional information point 4 just confirms the correctness of those two amounts. And then additional information point 5, the company's financial assets are held for trading with the intention of short-term profit making. So any cash flow that has occurred in respect of financial assets must be shown in the operating activity section because the financial assets are held for trading purposes. All right, so let us draw up a general ledger account for financial assets that would be recognized at fair value through profit or loss. Right, we start with the opening balance as reflected in the statement of profit or loss, or statement of financial position rather, 450,000. Here's the opening balance. The closing balance of financial assets at fair value through profit or loss is 500,000, which was carried over from the credit side in order to be reflected as a debit balance. Okay, then we need to consider the impairment on financial assets that was stated or given in additional information point 1. The 20,000, this would have caused a decrease in the value of financial assets at fair value through profit or loss. Right, we have already adjusted this amount against the profit before tax. So the balancing figure, which will definitely be on the debit side, because this side amounts to 520 and we have 450. So the balancing figure will be on the debit side. So this implies that there was an acquisition of additional financial assets during the year. All right, and this amount will be calculated as 520,000. Okay, the 500,000 plus the impairment losses of 20,000, and then we just subtract the opening balance of 450. This will give us a total value of 70,000. So this represents acquisition of additional financial assets, which therefore must be shown as an outflow in the operating activity section. Right? The acquisition of financial assets at fair value through profit or loss that is held for trading. We have calculated it to be 70,000. We need to show this as an outflow in that section. So please make sure that you disclose it accordingly. All right, we are done with all the points under additional information. So we just need to consider any remaining changes in the statement of financial position. We still need to calculate the changes in working capital. So let us start with trade and other payables. So trade and other payables, in order to calculate the change, so in order to determine whether there was an increase or a decrease, we need to take the closing balance and subtract the opening balance. Okay, so the opening balance for trade, the closing balance, because we are starting with the closing balance in this calculation, for trade and other payables is 755,000. However, this amount included the dividends payable at year end, which was 30,000, as well as tax payable at year end, which is 30,000. Those items have been shown separately in the operating activity section, so we need to remove the relevant balances. Okay. Then the opening balance for trade and other payables was 450,000. However, this amount included dividends payable at the beginning of the year of 45,000, as well as tax payable at the beginning of the year of 80,000. In order to calculate the change in trade and other payables correctly, you need to remove balances that have been taken into account separately. Okay. Now, if you do this calculation, you will see that there was an increase in trade and other payables that amounts to 370,000. And because this represents an increase, this will be shown as an inflow in this section right here, 370,000. Because if there was an increase in the value of supply accounts, it means that the company has utilized credit purchases more during the year, which means that more cash was retained. All right, so therefore we showed as an inflow 370,000. All right, then we look at long-term borrowings. There was clearly a change or an increase in long-term borrowings. So an additional loan has been acquired during the year, and this will be shown in the financing activity section. The proceeds from long-term borrowings, which will just be the difference between the closing balance of 2,355,840 and the opening balance of 124 is then subtracted. And because an additional loan has been acquired, this will be shown as an inflow in the financing activity section. So the additional loan amounts to 2,231,840 Rand. Okay. Then we need to consider the change in share capital. It has changed from 300,000 to 700,000. So it is clear that additional shares have been issued during the current financial year. So the proceeds from the issue of shares amounted to 400,000. Which is also shown as an inflow in the financing activity section. Then we need to calculate the change in trade and other receivables. There was no credit losses, there were no credit losses written off during the year, which we need to consider. And there are no other balances included in trade and other receivables. And if you compare the two balances, you will see that there was an increase in trade and other receivables, which we will show as an outflow, because it implies that there were fewer debtors who settled their accounts during the year. So the company has received less funds from their debtors or its debtors. Okay, the change in trade and other receivables, or the increase, is 70,000, which is shown as an outflow. And finally, we need to consider inventory. There was a clear increase in inventory, which means that more funds have been invested in inventory. So that makes less cash available for alternative uses. So therefore, it must be shown as an outflow. Okay, 1.1 million. Okay, increase in inventory, 1.1 million less 950,000. So there was an increase of 150,000. Okay, and then another item that we have not considered yet, if we go to our statement of profit or loss and other comprehensive income, is finance costs or interest paid. There is no interest payable at the beginning or the end of the current year. So therefore, the amount that was actually paid in respect of interest amounts to 102,000. And once again, this is an expense item that is included in the profit before tax, but in respect of which the cash flow is shown separately. So therefore, we have to remove finance costs from the profit before tax amount. So interest expense must be removed. We are removing an expense item, which means that we increase the profit before tax amount. So the cash generated from operations amounts to 3,395,000, which is also the amount that you should arrive at if you used the direct method. Please have a look at the suggested solutions where the direct method was applied. You will see that the cash generated from operations amount is also 3,395,000. Okay, we should arrive at an amount of 400,000 once we add up all the amounts of the respective sections. So the net cash from operating activities amounts to 2,254,160. Net cash used in investing activities, 4,486,000. And finally, the net cash from financing activities amounts to 2,631,840 Rand. So if you add up all three amounts, you should arrive at a net increase of 400,000, which means that we have drafted our statement of cash flows correctly. Okay, I hope that this lesson has been very productive in respect of the statement of cash flows. I hope that you now understand the indirect method better than before. So we are done with this exam paper. During the week, I will try and upload 1 or 2 more lessons that addresses, of which one will address the group financial statements and the other one will be a statement of cash flows question. I'm still deciding whether to use a question from tutorial letter 102 or a question from a previous exam paper. However, I have covered all the 2022 exam papers on Google Classroom. So the exam paper, if I'm going to use one, will be either from 2020 or from 2021, excluding this exam paper that we have already worked through. Alright, ladies and gentlemen, this then concludes today's lesson. Please inform me if you have any additional questions regarding the statement of cash flows or group financial statements, whatever the case may be, so that I can try and assist you as best as I can. Thank you very much for watching this lesson. I will see you next time.